Okay, it looks like we're live. So hello everyone, greetings and welcome to Deloitte's Debrief's tax webcast series in Asia Pacific. Our webcast today is from our transfer pricing series and is titled Renewables and Clean Energy, New Transactions and Transfer Pricing Themes. My name is Mark Barker and I'm based in Melbourne and part of the Deloitte Australia team. And I have the pleasure of hosting today's webcast. I have four expert speakers that specialize in transfer pricing with me today, and also in the renewables, specialize in the renewable space. I've got Subha Dasgupta from Deloitte Malaysia. I've got David Bell from Melbourne, Australia. I've got Hamish Clark based in Singapore. And I've got Oki Olivier based out west in Perth, Australia. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. Firstly, all users are on listen-only mode. If you have any content-related questions, please do submit these at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. However, if we do miss any of them, we'll try to get back to you on email afterwards, or through our bios. Please also do reach out to us on those emails if you have any questions afterwards. Second, all PC users can maximize or minimize each box at your convenience during the webcast. So if you want to make the slides bigger or make our heads bigger, whichever you think is better looking, go for it. You may also explore the icons at the bottom of the screen if you want to download today's slides and related publications. Please go to the downloads and links box. On the other hand, the same features are essentially available for mobile device users, so you can also access the same features there. Thirdly, if you require any attendance record for the event, you will receive an automated email with a CPE certificate after watching for 50 minutes. So stay on if you need to get that certificate by then. Can we now move to the agenda though, please? Next slide. So we have a jam-packed agenda today to talk through. And to start off, we're going to set the scene by talking about broader renewables-driven business transformations and some of the broad transfer pricing implications at a macro level. We're then going to dive into some of the key transactions we're observing across multiple industries. And there's four key intercompany transactions we're observing at the moment in this space, and we think they're going to be pretty significant going forward. The first one is green finance. The second one is emerging green technologies and the reporting of intangible assets. The third one is the trading of carbon credits. And the fourth and final one is the export of hydrogen and other renewable energy classes. Now, to close it all off, we will have a bit of a Q&A session. And as I said, please do reach out if we can't get to all of the questions. Now, to kick us off, what we thought we might do is we'd start straight away with a poll question, just to get a sense of everyone listening's experience in this space so far. So if we can, there's the poll question up. So the poll question is for all our listeners: in your organisation, is the tax and transfer pricing function involved in ESG discussions and strategies? And you have a few options there. You can say yes, you're an active participant. You can suggest you're a passive participant, informed only, and manages certain reporting, like country by country reporting, not involved at all, or don't know and not applicable to your organisation. And we can see some results starting to come through live there. But whilst we wait for those results to crystallise, just a quick question for you, Subha, perhaps. I know recently we've published, and it's attached to the materials as part of this webcast. We have a Deloitte survey recently released on 5 ways tax leaders can help achieve sustainability goals. Now, in this survey, we know that 89% of the sample had a chief sustainability officer, What did the survey results say about how closely tax managers work with a company's chief sustainability officer?
Thanks, Mark. So that number would be 72%. So 72% of the respondents indicated that they work very closely with the chief sustainability officers. And that is a good place to start a deeper conversation, if you ask me. Uh, the influence that tax has on businesses' sustainability targets varies by industry, but majority respondents in this survey from across industries said that their business sustainability targets are influenced or very influenced by carbon or environmental taxes. So before we move forward with this, let's look at the polling results. Okay, not surprising from the conversations we have had. Could we move to the next slide, please? And let me share why we feel that tax will play a very pivotal role in business decisions on decarbonization strategies. And I'll put forth three reasons. One, the tax function needs to be capable of providing the business with a longer term view that includes potential tax incentives available to support the transition to net zero. Given that various governments are introducing more green incentives, supply chains within the traditional business models would need to adapt to make optimal use of such incentives. Number two, businesses working across multiple jurisdictions must navigate an increasingly complex environmental tax landscape. Tax teams therefore have a key role to play in identifying potential environmental tax costs which are likely to impact the business. And number three is the increasing external tax disclosures that are likely to lead to greater scrutiny of tax decisions, resulting in tax teams having to manage both tax technical and reputational risk. Finally, one thing which tax teams should also focus on is hydrogen. Clean hydrogen has the potential to decarbonize energy systems and heavy industries, but producing clean hydrogen at scale requires tremendous infrastructure investments, which governments are looking to incentivize through grants and incentives. Accessing these opportunities, which can substantially reduce the cost of investment, needs a proactive approach rather than a reactive one, and hence the tax function should be at the forefront of these conversations. On the next few slides, let me give our participants a macro and micro view of the business model transition strategies driven by decarbonization and the associated TP risks and opportunities. Could we move to the next slide, please? Next one. Okay, thanks. Let me start with the current state of play in Asia Pacific renewable energy market. Based on the 2020 consumption levels, this is dominated by hydroelectricity. However, wind and solar energy are gaining popularity. The two foremost positive drivers of shift towards renewables are government regulations and health and environmental concerns, and the energy security and independence agenda due to geopolitical reasons. Concurrently, there are two key challenges for renewable energy companies. One, the increasing operational cost, especially the cost of developing low carbon technologies. And number two is the dearth of financing, because there seems to be a bottleneck in the global financial infrastructure that supports lending to renewable projects. Could we move on to the next slide? So staying with the macro, we hear conversations around two types of risks: physical risks, which are due to changing climate and associated costs, and transition risks, which are essentially risks inherent in policy changes and changes in business strategies and investments as a consequence. Now, both of these risks are not confined to businesses that implement or fail to implement a transition to a lower carbon approach. Types of transition risk actually exist within the broader economy. Just to give an example, if government policies worldwide change in line with the Paris Agreement, two-thirds of the world's known fossil fuel reserves cannot be burnt. And this would affect the energy companies and would also change the value of investments held by banks, insurers, or pension funds in coal, oil, and gas companies. We also see a whole host of new corporate management tasks being undertaken at the headquarters or by specialized teams stationed elsewhere focused on this road to net zero. And these can go beyond traditional management or shareholder services and may not qualify as low value adding. Finally, we are witnessing increasing changes to business models, development of new products and processes that are resulting in additional costs or cost savings in some cases, and participation in new trading regimes such as carbon trading, carbon credits. All of these give rise to a number of transfer pricing issues, and I'll give some specific live examples for the benefit of the participants today. Could we move on to the next slide? Let me start with business restructuring, right? So we have had conversations around decentralization of manufacturing functions within a group to reduce carbon dioxide emissions from transport that typically increases if the production is set up in a centralized way. We have also had opposite examples wherein there is insourcing of certain manufacturing functions where the group has non-compliant external suppliers which fail to deliver on renewable energy usage commitments. Another possible restructuring example may be centralization of logistics and fleet management or management of external supplier contracts to reduce the global emissions footprint of the group or to meet external reporting obligations. Typically, such a team is remunerated on a cost-plus basis, but such deliberate concerted group effort may result in the group generating a distinct advantage over other market players, and hence the transfer pricing basis may require a revision. Moving on and to look at the functional analysis standpoint, which is the core of any TP documentation that we prepare. There are additional investments in carbon efficient production assets. Question is who should bear these additional costs, the local routine entities, the principal, or the headquarter? It may not be possible to pass these extra costs to customers. There are various costs being incurred in the context of decarbonization strategy within a group. Question is who should bear these costs? Are these purely shareholder costs, or does the strategy create new intellectual property? And what is the resulting profit allocation? Finally, documenting new types of risks in the functional analysis, such as those dealing with business continuity, is gaining momentum. We need to be mindful that statutory auditors have to report on business continuity based on carbon footprint, which can also impact the borrowing ability as banks are adopting new lending practices and credit agencies are incorporating climate change in credit rating models. Investors are willing to lend at a lower rate for higher ESG credential, which in turn gives rise to the question, who should benefit from the savings of lower borrowing costs? So that's a big picture. I will stop there, pass it to Oki and Dave for a more in-depth conversation, and we will start off with green finance. Oki, Dave, over to you.
Thanks very much, Suba. So as we go on to the next slide, we'll dive a little bit into this whole concept of green financing and what that means from a transfer pricing perspective. So as you can see on the graph on the right, one of the biggest sustainable changes that we've seen across the capital markets in the last few years is this growth in green bonds and green financing more generally. Just in the bond market, you can see there in 2021, this represented already 450 billion worth of funds. And it's estimated that in 2022, more than $1 in every $10 that are lent by financial institutions are in the form of green financing. Now, the reason for the growth in this area is because the financial institutions and other funds have their own net zero targets, and they are therefore providing incentives to borrowers to borrow funds that are earmarked for specifically low emission activities. And the incentives that they provide are sort of twofold. On the one hand, it provides a higher debt capacity and ability to borrow to the borrower. And secondly, what we're seeing is more favorable lending rates. So discounts on typical interest rates are paid for similar loans, and we refer to this as the greenium that borrowers, and in particular in our context here, multinationals, are able to access. Now, the requirement to be able to qualify for these green bonds and other green finance is really sort of tied down through a number of very strict requirements that needs to be met by the borrower, in particular in the way that the funds are being utilized. So what this would generally mean is that the green bonds are tied to specific assets or low emissions activities. And the most commonly used set of principles is the green bond principles that are used and followed in most of the bond markets. And what that means ultimately is that a very significant part of funds that we're currently seeing that are flowing at arm's length into multinational groups have these very unique and new specific sort of features that we have to take into account when we consider the transfer pricing implications. And on that note, I'm going to pass over to David to talk us through some of those implications we are seeing at the moment.
Thanks, Oki, and we'll move on to the next slide, please. There really are some very interesting features from a technical transfer pricing perspective of renewable finance, and in particular, some of these green bond instruments that are now being issued by government and semi-government organisations, but also to an increasing extent by corporates. I think the first important feature from a transfer pricing perspective is that green financial instruments are not fungible. So typically the funding that's raised using green finance instruments is subject to qualifying conditions. And those conditions require the funding to be applied to specific activities or specific asset development that meets certain environmental objectives. As a result, to comply with the arm's length principle, we need to be able to demonstrate that the benefits earned on green instruments are shared on an arm's length basis with those group members or those entities that are responsible for the activities that address those qualifying conditions or address those environmental objectives. So in essence, the funding that's raised by green instruments needs to be hypothecated and directed towards the entities within the group that invest in the qualifying activities or assets. The greenium that Oki mentioned earlier, or the discount on the cost of financing obtained through projects that address specific environmental objectives, should flow through to the group members that enable a global group to achieve those objectives. So, as an example, if some qualifying green bonds are issued by a central treasury entity that's based in the UK or in the US, but the qualifying activities are undertaken in China, then the reduced costs of finance should be realised in a cheaper cost of intragroup financing that flows through to the Chinese entity. So, unlike what we've often seen in the past, where a group cost of funds results from a blend of various sources of finance, with the advent of green finance, we need to take care to move to scenario 2 that's shown on this chart and keep a separate record of the use of any green finance that's raised. The fungibility of these green finance instruments can also affect existing intragroup loan pricing policies. Many multinationals operate with a funding framework that effectively blends all of those different funding sources, and financing sources provided to operating assets are definitely fungible. So consequently, it's passed down as a mix of funding sources. We can no longer do that with green bonds. It's not possible to mix the green funding with that broader portfolio. By doing so, you may in fact risk voiding the green status of the initial funding, and that would mean that the group as a whole would miss out on the greenium or the benefit associated with that status. So it's very important that multinational funding policies and processes are amended and updated to ensure that there's an accurate delineation of green funding sources, that they're separated out in policies, and that they're clearly connected to the specific activities or assets that qualify for that. Another important question that comes up technically around green finance is how implicit support should be recognised. So in the example we mentioned earlier, where funding flows from the UK to a Chinese entity, how do we amend that cost of financing if it's affected by the fact that we've got a global parent of the group based in Australia, for example? Not only by the greenium, but also it's affected by implicit support to some extent. In those cases, it'll be important to document in any intragroup policies just how the effect of implicit support has been quantified and how that's recognised separately from any greenium. The final point I'd make is that the advent of green finance requires us to recalibrate ERP or accounting systems in many cases. It's important that we're able to demonstrate within a group just how the qualifying conditions of green finance have been met, what activities have been undertaken by which entities, and that's going to require some recalibration of those reporting systems to report on operational aspects that may not be reported on at the moment. I think the key message coming from each of those issues is that it's important for groups to get on the front foot and proactively consider the impact of issuing green finance on existing intragroup finance.
It looks like we've just lost David there. But yeah, I think one of the key things that we were also thinking about around this concept is just from a group perspective, a lot of our clients have funding policies where the credit rating is determined individually for each entity. And then the question that comes up is, if we have green financing coming into that group, how do we take that into account in such a policy? And I think that the key there is to make sure that, like Suba was saying earlier, where external rating agencies would take into account the impact of ESR initiatives, that should be taken into account here. But ultimately, the key is to make sure that that greenium is appropriately shared across the different entities that's driving the saving for the group as a whole. Dave, it looks like you're back.
I am, Aki. Thank you very much for that, and apologies everyone for dropping out there. It's a tough time for the internet performance in this part of Melbourne today, unfortunately. Thanks very much for that, Aki. We'll move on to the next slide if we could, because the next theme we wanted to touch on is green intangible assets and the impact on intangible asset analysis of the increased investment we see in renewable activities. Total new investment globally in renewable energy was just over $300 billion in 2019, according to the United Nations. Of that, around 149 billion, or half of it, was spent in our region. Of the 300, around $80 billion was spent in 2019 on research and development and on technology development of renewable energy sources. If that's shared in proportion to the total regional spend, there's around $40 billion a year being spent in Asia Pacific on innovative activities around renewable energy. That will give rise to significant intangible assets being developed. It represents a significant investment, and in recent years, we've seen tax authorities across the region starting to increase their compliance activity in investigating how intangible assets are compensated within multinational groups. Tax authorities across our region have been seeking to apply the OECD framework that emerged from the BEPS project and now constitutes Chapter 6 of the OECD guidelines. That's the framework that focuses on management and control of key risks and performance of DEMPI activities. And it makes a big shift away from the reliance on legal agreements to define the roles of different entities within a global group in relation to intangibles and how different entities should be compensated from them. Increasingly, we're seeing tax authorities request documentation that goes beyond a standard transfer pricing analysis to assess how intangible assets should be compensated within a group. I'll hand back to Mark now. Mark, given the extent of that investment that we're seeing in green intangible assets and in innovative activities, where exactly are we seeing that investment going? What sort of technologies are driving such a high level of investment?
Thanks, Dave. And we might jump over to the next slide to take a look at that. So these investments are going into predominantly your traditional green technology classes. So that's mostly your wind assets and solar assets. They've been staples for a while. Now, those technologies continue to improve as there are incremental efficiency gains to gain in both wind and solar. So by no means have those asset classes reached the end of their technology curve. However, a lot of investment is going into some of the next generation green technologies. And so a few of those are hydrogen, biofuels, battery technology to store a lot of the wind and solar power actually, and also carbon capture, which if you read some of the recent publications from The Economist magazine, it looks like 1.5 degrees Celsius might be difficult to reach at the moment, and so carbon capture is probably going to have an increasing role if we are to meet 1.5 or 2 degrees targets at the upcoming COP27 meeting. Now, these technology classes, especially these newer ones, these are what I'd call some of the sexier asset classes. And why I say sexy, multinationals are tending to broadcast their investments into these technologies very, very publicly through shareholder publications or announcements to the marketplace. Now, why that is important is often the tax function is not as quick to keep pace with some of that broadcasting, and so a key message here is to try and have tax at the table when those broadcasts are made, so that any of the broadcasting is also aligned and reflected in transfer pricing documents and transfer pricing policies. Now we'll have some more granular advice on that in a moment. But the other key thing to note here is that the development of these technology classes is very much, these new technology classes is very much in its infancy stage. So the other key thing Dave touched on beforehand was how important DEMPI activities are and how important risk is when you're talking about intangible assets, and particularly who's bearing the risk. And one key theme with these asset classes is a lot of them have not necessarily got proven commercial success. So unlike wind and solar, there is considerable investment and an investment footprint and a lot of DEMPI activity that goes with that investment footprint to get these technologies launched, but not necessarily a commercial success story yet. And that means certain entities in a group structure will be bearing potentially considerable risk. Now, if we can move to the next slide, let's bring that to life with a bit of an organizational diagram. And so some of those points I touched on become apparent when you see this illustrative value chain of actually what's pretty common in a multinational structure, where you're going to have your asset companies that are effectively going to get the benefits of most of this deployment of these technologies. So that might be wind farms located in various jurisdictions. But you're going to have an IP company in a central location to usually get the benefits of critical mass and thinking in one specific location. And those locations could be in a range of areas. But if we take wind, for example, the UK and Denmark are leading providers in wind. So there's a lot of IP that's been developed there over time, and there's a critical mass developing there. And so those locations will tend to often be different from sometimes where the asset locations are. You're also, in parallel to those arrangements, you're going to have other development companies that might produce, for example, some R&D functions on behalf of the IP co, and they might be unrelated to the absolute core technology, but might be a supporting piece. So in wind, for example, the role of artificial intelligence and algorithms and data is very, very important. So you might have an R&D center that's doing purely the artificial intelligence piece of the project, and the intellectual property around that will be potentially in a separate location from the centralized IP co. And you'll also potentially have manufacturers, third-party manufacturers involved in the supply chain that have various components of technology embedded in their underlying product. It might be, for example, the manufacturer of the wind blade and the angle that wind blade is machined at will have some specific IP embedded in that product, and so there will be relationships and some IP, as you can see in this arrangement, with the third party potentially baked into the underlying product, with a development co, in the example I gave, doing some sort of data-based services, and then with the central IP co, who may put all the product together and package it and launch it on behalf of the asset co. So you can get some pretty fragmented arrangements here, and this is really not too dissimilar to what we've seen in more mature industries where intellectual property is not a new theme. So if we think about pharmaceuticals and also the technology space, and potentially also fast retail, where trademarks are a key feature, I suppose the key thing those industries have is they usually have very dedicated teams to think about their intellectual property strategies and how they document those strategies. And often also they need to do it for accounting reasons because they need to meet IAS 38 accounting standards. What's potentially a bit unique as we move our way and pivot to a more renewable space is a lot of the technologies I have mentioned really won't necessarily fall under a trademark or a patent. But as Dave touched on beforehand, that they will fall under the Chapter 6 OECD guidelines definition of an intangible, and that they might be know-how or something else that's not necessarily legally registered. So what is potentially a challenge here is documenting this and getting the record of intangibles readily available for preparation for tax purposes. And what we're finding the most proactive clients do and multinationals do is they are actually going through a registration process, sorry, not a registration process, an inventory process, where they are developing inventories internally for operational purposes, but also for tax purposes, to record the value of these intangible assets and record these intangible assets in an internal system so that they can be used for operational purposes, but also used for tax purposes later on. Now, a big part of this also includes updating various enterprise resource management systems, ERP systems, to make sure, in addition to just capturing the headline activities going on and where they're located, also trying to keep a record of where costs are going into the development of these assets. Now, the reason these two activities are a pretty proactive and useful thing to initiate early on, if some of these new green intangibles are being developed, is because, as we touched on beforehand, there is a lot of public broadcasting in the marketplace on these technologies being developed. There is also a lot of risk potentially in these arrangements, because one entity is potentially bearing a lot of cost on a project that's not necessarily commercialized yet. As we know, if there's going to be cost there, potentially there's going to be a mismatch with losses, for example, in this illustration in the IP co, with all the benefits going to the asset co, or the asset co not receiving the asset at all because the technology never eventuates. So it is very, very important to be documenting these intangible assets and costs right now, so that later on, when tax authorities might look at this, noting that tax authorities always have the benefit of hindsight often when they apply audits, the benefit of documenting these processes early on, so there is a well-established framework for how intangible assets are recorded on an inventory, and the costs associated with those intangible assets are recorded as well. The second key theme is the critical importance you're going to have around people functions. So Dave touched on DEMPI functions, so development, enhancement, maintenance, protection, and exploitation of some of these intangible assets that's being created. And I think in this case, it's very, very clear to make sure that intercompany agreements and also documentation are very, very clear on who is bearing the risk and delineating that risk out with specificity. Now, that's sort of language that the OECD guidelines uses, and often that can be taken for granted. But in the situation of some of these technologies that aren't fully commercialized, making it very clear early on in agreements and also TP documentation, if there's a fragmented development structure like in the diagram to the right, making sure that is very, very clearly documented and defined is really, really important. And this includes also having a look at agreements with joint venture project partners and suppliers, so the dark green box in the document, in the diagram to the right. And the reason that is really, really important is because a lot of those third-party commercial agreements actually will have some pretty sophisticated clauses around the treatment of intellectual property, and it's often useful to use those clauses as a starting point for basing intercompany agreement policies on. So you have a commercial basis for setting some of your methodologies for sharing intellectual property amongst other group members. Now, I'm going to change gears because there's a lot we can talk about on intellectual property, but I want to move on to our third theme for today. So if we can move on to the next slide, please. And that is carbon credits. And so as of this year, more than 2,000 companies have or are planning to set a so-called internal carbon price. And that price is effectively a monetary value on their own emissions as they move to decarbonize. Now, carbon credits, a lot of groups will directly try and decarbonize, but carbon credits are an effective way to meet short and medium-term goals to immediately offset credits. Now, there are effectively two types of carbon credits available in the market, and both of these can be traded on an intercompany basis. And so the first one is regulatory credits. And so regulatory credits covers about 23% of global emissions, and about 31 jurisdictions worldwide have effectively a regulatory carbon credit regime. The most common one that folks are probably most familiar with is the European Emissions Trading Scheme. That's the biggest one. And effectively, most operate in a similar fashion to the European Emissions Trading Scheme in that the regulatory regimes are effectively cap and trade systems. So the regulator will set a cap on carbon, and then you can buy credits within that cap, and you can emit, and basically your cost of carbon is reflected in the cost in trading those units. Now, the wonderful thing about the regulatory market is that it has a secondary function, so it can trade on secondary markets, and these are very, very popular in the marketplace. Now, the second type of carbon credit available is voluntary credits. So as I mentioned, only 23% of emissions are currently covered by a regulatory regime. So that leaves the vast majority uncovered. So what a lot of groups are looking to do is in situations where they don't necessarily have a regulatory requirement to meet an emissions trading system or regulatory regime, they are effectively purchasing carbon credits on a voluntary basis. So this usually involves an asset class or a producer that will, for example, develop a forest, and then from that forest that will offset a certain number of emissions from going out, and as a consequence of that, there is a capped amount of emissions that therefore can be credited against, and those credits can then be traded later on. So voluntary credits, the difference is that they vary in quality. So they're not supported by a regulatory regime, but there is a vast array of quality between those classes of credits. So what this all means is that between the regulatory environment and the voluntary environment, there is a really, really wide range of carbon prices out there. You can see in the chart to the right-hand side that carbon prices can vary from anywhere from as low as $1 per ton of effective greenhouse gas emissions, right the way up to over close to $100, according to the latest World Bank data. And that's just the regulatory credits there. There's an even wider gap when we talk about voluntary credits. So that presents challenges because you've got multiple types of credits available. and then you've got multiple prices, and there's also quite a bit of expertise that's required to trade these credits. So what we're starting to observe is often some intercompany structures that are set up to assist with this carbon credit space. And there's effectively three types of arrangements observed at the moment. I'm sure there might be more as this space evolves. But the first one is just effectively a centralized procurement activity, not that dissimilar to existing procurement functions, where you'll have one centralized entity that has the expertise in the marketplace. Maybe they have the financial services license required to procure the carbon credits, and they'll procure them for the benefit of the carbon emitting assets, maybe located across the globe, but also potentially for the benefit of the ultimate parent company. The second type of trade we're seeing on an intercompany basis is, again, that centralized procurement function. But in this situation, carbon credits are being purchased with the view of optimizing or bundling them with underlying products that the group would sell anyway. So it may be that entity that's doing the procurement function also has a trading hat or a trading function as well. And as a simple example, if they're going to trade an emitting commodity class, like copper, for example, if they're going to trade copper, they will sell the copper to the marketplace, but they will stick a carbon credit or bundle a carbon credit with that copper product and sell it potentially at a premium in the market. And that's going to bring up some pretty interesting transfer pricing issues that we can discuss potentially shortly. The final main structure we're seeing is just simple trading structures where there is clearly a wide array of prices of carbon available in the market. And as a consequence, you're going to get arbitrage trading positions where you can buy low and sell high. And so not too dissimilar to other banking or commodity trading arrangements, we are observing integrated trading functions where there's a portfolio and potentially two trading desks located in jurisdictions, and the transfer pricing policy for sharing profits or losses between those two entities needs to be considered. Now, with that completed, I would like to hand over to Hamish, because Hamish is from the Singapore office and will have some more experience talking about some of the broader observations on carbon credits and also the application of some transfer pricing methods. So, Hamish, over to you.
Thanks, Mark. And you raise an important point there, because we're seeing the carbon offset market growing significantly. And we're also seeing carbon or existing commodity traders evolve and move into the carbon credit trading space. And then that means that we're working with a number of clients at the moment to help them price their intragroup sales and purchases of the new commodity class of carbon credits. So I'll talk a little bit about the sorts of transfer pricing methods that we're seeing applied to the various business models which you described, Mark. So the first thing to note, of course, is that the normal transfer pricing rules and principles apply. So we always start by making sure that we've got a good understanding of the business model, that we've identified the related party transactions, and that we've got a good understanding of the functional profiles involved in the related party transaction. So we saw on the last slide that Mark outlined the possible or the different types of business models that we see within multinational groups. We'll go through all of these different business models and try and map that to potential transfer pricing methods. I'll go through the table at the bottom of the slide and try and give a feel for the different ways that multinationals set up their carbon buying and carbon trading activities and how that corresponds to different potential transfer pricing methods. So if we start with regulatory offsets, we already mentioned in the last slide that this is where you've got a carbon emitting asset that's required to reduce its emissions, and then implicitly, therefore, it's required to purchase carbon credits from a regulated market. Now, we often see multinationals centralize their operations. So in order to gain commercial efficiencies and have a single interface to the market, the group will choose to have a central point that are procuring these regulated credits for the assets. So under this sort of circumstance, what we're typically seeing is that the procurement operations, which is sometimes an extension of an existing commodity trading desk, for this purpose, they're undertaking quite a routine transaction. So they're purchasing on behalf of another group entity. They'll then sell on the carbon credit to the asset, which needs to retire the credits and offset that to reduce their net emissions. But where you've got the carbon desk taking less risk and undertaking more procurement type activities, then the sorts of TP models we'd expect to see would be more cost-based, or maybe in certain circumstances they'd earn a margin based on the value of the credits, but they'd only be earning the extra margin where we can demonstrate, where the taxpayer can demonstrate that the carbon trading desk is adding extra value by buying at the lowest possible price. So that's a feel for the regulatory offset intragroup transactions and the TP policies that we typically apply. But we then go on to the voluntary offset market. And as we saw in the previous slide, this is a bit of a wider range and a bit more of a flexible market, if you like. So what we see here is that multinational groups often want to show a commitment to reducing their overall emissions. And in order to do that, for pleasing certain stakeholders or for the good of reducing their overall emissions, they'll enter the voluntary market and choose to purchase carbon credits. And then that purchasing or that trading of carbon credits is often done through a central location and a central entity. And then once again, that central entity is often an extension of any existing commodity trading entity, because again, it's offering a single face to the market and a single hub of expertise. But given the variation in prices between the different types of offsets when it comes to the voluntary market, there's typically more room for arbitrage, more room for generating extra profits through the purchase and sale of the carbon credits. So therefore, we typically expect to see the multinational, the entity within the multinational that's doing the purchasing and the trading of the carbon credits. They tend to be more involved, say, hold a bigger stock of credits, maybe manage more risk for the group as well. Therefore, the TP policy has to be a little more advanced. Rather than having a cost-based TP policy, we typically then see the carbon trading desk earning either a margin of the value of the credits. They can also earn a profit split, so the incremental profit that they can add, or the cost they can save, can be split between the asset and the trading desk. But overall, with the voluntary credits, it's a much more variable market, much less developed and commoditized. So in correspondence with that, there's a wider range of TP policies that we see applied. And then the final group of, or the final broad business model that we've identified is the bottom row there on the slide, on the table on the slide, where we've said the carbon trading desk can also take a more entrepreneurial approach. It can be, it can have the capacity and it can have the capital to be fully involved in the trading, like they could be trading any other class of commodity. So they'd be trying to optimize the flows, generate extra profits. One example, which Mark said, is that they could take an existing commodity and bundle that together with a carbon credit, or with sufficient carbon credits, that it means that cargo of the commodity effectively becomes a net zero emissions cargo, and then it could sell on a cargo as a green cargo into the market. So where we see the carbon trading desk being much more involved in the overall trading, taking on more significant risk and taking on true fully fledged trading activities, then the corresponding TP policy would reflect that extra risk. So they may well get the entrepreneurial return, so they keep all the profit that they generate as their own trading entity. We've also seen profit splits put in place in that sort of scenario, where they recognise the importance of the desk being connected to the emitting asset. Therefore, they split the profit with the trading with the carbon emitting asset. The overall picture here is that we're starting to see the business models developing. It's still at an early stage, but as we see the business models developing, we're starting to see patterns and trends in terms of the types of TP policies which multinational groups will use to price the different types of intergroup transactions which we see as the business models develop. Now, overall, we still are at an early stage in the development of carbon trading and the types of related party transactions you get when it comes to the buying and selling of carbon credits. It might well be possible that we just have a simple transfer pricing policy to begin with, and then we keep a flexible approach. So as the business model develops, the TP policy can also change or be updated to reflect the new business model. So that just gives us a flavour of carbon credits as a new commodity class. But I'll just go on to the next slide and spend another few minutes looking at another new commodity class and another new area that we're seeing developing. So in particular, we're looking at the fast-growing area of hydrogen exports. So as we say, this is a new class of commodities. So as such, there's not currently a market reference price available. This is a bit like if you look back at the liquefied natural gas, the LNG market from 10 or 15 years ago. It was very difficult at that stage to find a reliable price index, an independently published price index, because there just wasn't enough sort of spot or short-term trading going on to establish a reliable market price or reliable cup. And then even if you go back many decades, that was the case with crude oil as well. So as the energy industry develops, moves towards green and zero carbon initiatives, we'll see hopefully a number of new commodities being exported and being traded, and hydrogen is a good example of this. So we think of hydrogen effectively as a new supply chain. A lot of the transfer pricing points which we've made so far in this presentation will also apply, and will come to the fore through the product life cycle. As what we've covered the fact that there may not be a market reference price for the hydrogen itself, but that's just one potential intragroup transaction. You've also got to think about all the other related party transactions, things like intangibles, which will be related to the R&D, which is being developed now to develop the export technology. You'll probably have intragroup financing in there. There'll probably be engineering services in there as well. So a whole host of different potential related party transactions which need to be considered as part of a new supply chain. So at this stage, I'm just going to ask Oki and hand over to Oki to delve into a little more detail on the hydrogen exports.
Yeah, thanks, Hamish. And I think that point around the supply chain, I think it's really important to understand that a hydrogen plant will never operate in isolation. So there's in order to generate green hydrogen, it has to be linked to some renewable energy source, a wind farm or a solar farm. So that already adds some complexity. And then you have this sort of after the electric process, you would end up with a hydrogen molecule with a particular calorific value that will then flow through, say, a storage facility. It will go to a port with a particular loading sort of platform. It will then go onto a very specialized vessel in order to transport the hydrogen to the other side. You will have a receiving terminal. You may have some more storage, and then ultimately the hydrogen will be sold or used in electricity generation. So each of those different points along the chain, that particular molecule could have a different value. There may be a different taxing point, and it'll be important to understand. And I think, like Hamish is saying as well, each of those processes could potentially have their own DEMPI functions, require their own financing, and be sort of have their own intangibles, etc. So what it brings is just a whole lot of complexity across sort of the whole supply chain. We're seeing a lot of sort of new projects popping up in Australia at the moment, where large multinationals are just dipping their toes into the industry. There's some proto plants that's being developed, and each of those, even though they may be small at this stage, will have that very significant level of complexity. And that's probably why we are sort of expecting to see a lot of APAs in this space, to get that certainty, to take tax authorities along for the journey. And there will probably also be a level of education required for the tax authority. So while all of this, and for all of us are really interested in this area, while it's very exciting and new, it does bring a lot of uncertainty. And ultimately, the only way to get certainty around those things so at 100% level will be through an APA process. The other thing, just going back to the pricing of hydrogen, I think the trap that we could often fall into is to think that because it's such a new industry that we'll only really start seeing significant transactions, say, in 5 years' time. But even now, when some of these projects are looking at financing, project financing, doing models, making investment decisions, the pricing sort of assumptions as part of those decision-making processes become really important. And therefore, in many cases, from a commercial perspective, multinationals are looking to the transfer pricing teams to help them to form some idea of what the pricing might look like in a few years' time. And what we've also seen is that tax authorities would often ask for those assumptions in those models around initial financial investment decisions. So on that note, we'll move to our final polling question for today. So the question that we have is, from a tax and transfer pricing perspective, which key renewable theme is likely most relevant for your organization to establish new policies and to support? So the options we have here are green finance, green intangible assets, carbon credit trading, export of new commodity classes like hydrogen, other or not a focus area. So while we wait for the responses to come in, I'll hand back to Suba.
Thanks, Oki. And while waiting for the participants to cast their vote, from my conversations, I think green finance and carbon credits would top the chart, followed by green intangibles. So let's see how the results come along. But while waiting for it, Oki, one question for you. From a practical perspective, what are some of the key things we should do now while we are raising green funds to make sure that we don't get tripped up later on the transfer pricing?
Yeah, I mean, I think there's a few things. I think the key one is just that this is something that's here now. So unlike some of the other things we've been talking about that are developing, we're seeing that as a significant part of financing at the moment. So it can't be ignored. I think the key thing is to make sure that we identify where those funds are coming into our multinationals so they can be appropriately ring-fenced. And then also recognize that our standard transfer pricing policies is probably not going to work. And we're going to have to either do a bespoke analysis or develop new policies for those kinds of funding.
Okay, no, that's helpful. There is one question which has come in. I'll post it to Dave because Dave, you spoke about intangibles. In relation to management and control of DEMPI activities for intangibles, what sort of documentation do tax authorities expect to see?
Thanks, Shubho. It's a good question because increasingly we're seeing tax authorities wanting to see more than a transfer pricing analysis and wanting to see what they refer to as source documents relating to DEMPI activities. The sorts of things they're asking for, and actually the ATO published a draft practical compliance guideline which spelt out a lot of these types of documents that will be referred to for these very questions. They published that late last year, and that described in detail more than I can go through today, but the sorts of documents we're talking about are documents that evidence which people or which entities were responsible for the decision to invest in the development of an asset. So they want to see business case documents, feasibility assessments, any documents that evidence approval of business cases. So that might be in meeting minutes of either management or audit and risk committee meetings. It might be financial delegations that demonstrate individual responsibility for decision making. Around management and control of DEMPI activities itself, we see tax authorities requesting details of position descriptions to evidence the qualifications and capability of individuals within an entity to have responsibility for certain decision making. And then a lot of interrogation of correspondence in email form or other forms that, again, evidences decision making processes.
Thanks, Dave. The next question has also come in through the Q&A, and this is for Hamish. Do you see the percentage of regulatory credits increasing significantly to meet Kyoto targets, and will this close the gap between regulatory and voluntary pricing? Hamish, your thoughts?
Yeah, I mean, it's a good question, and we don't fully know the answer, but the expectation is that the market will develop, the market will become liquid. It'll also become more commoditized. You know, the standards will be set as to what a credit needs to do, and what it, there'll have to be evidence to show that when you buy a carbon credit, that it is offsetting the, genuinely offsetting the emissions. So in that sense, we expect the pricing to become to sort of come together over time. In terms of the exact timeline that runs over, it's kind of difficult to estimate. But yeah, the market expectation is that the pricing will align.
Thanks, Hamish. And I'll pass it back to Mark for closing today's session. Mark, over to you.
Thanks, Suba. Yeah, and I said there's a few other questions that have come through, so we'll look at answering any other questions on email. And as we said, our emails are in our bio, so if any questions pop up later, please do reach out. But unfortunately, that is all we have time for now. So Suba, David, Hamish and Oki, thank you very much for your time with us today. We would like to encourage you to fill out the short survey form that will pop up on the screen momentarily and tell us what you think about today's program. And by you, I mean you, the audience there. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from the webcast, please share the webcast via the share this icon, or have them visit the Dbrief's website. We will also respond to all questions submitted during the webcast in the coming weeks if you do have any questions, as I said. Also, if you think of any other questions or comments, as I said, please reach out and email those. And please don't forget to tune in on our next scheduled webcast. Here it is on the screen, from the Indirect Tax team on the 17th of November, titled E-Invoicing and Real-Time Reporting Development in Asia Pacific. Our last point from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Have a wonderful rest of your day. See you later, folks.